Hello everyone and welcome to another episode of the Zerodha Educate podcast. My name is Prateek Singh, the CEO of LearnApp.com, where you can learn from the brightest minds in the world on investing and trading. Do check out LearnApp.com. Now, while the markets are taking a turn for the worse, we are continuing this series as we talk to some of the smartest and experienced people in the investment management industry. Today, we have a real veteran of the Indian markets with us. We're talking to I.V. Subramaniam, the MD and CIO of Quantum Advisors, also fondly known as Subbu. Now, he's been in Quantum since 1996. That's 25 years of experience in the investment management and financial services industry. Now, since June 2000, Subbu has managed India-dedicated portfolios for Indian clients. And since 2005, he's managed Indian dedicated portfolios for international clients as well. Please enjoy this conversation with Subbu. Thank you so much for doing this, Subbu. We had been planning to do this for a while now, but this is the perfect time given what's been happening in the markets and also how many years of experience you've had in the markets when you've seen all the cycles. So thanks for doing this, Subbu.
Sure. Thank you. Thank you for inviting me for this show. Thank you very much.
Great. So the first question is, Subbu, you've been in Indian markets even before the National Stock Exchange existed, right? So how did you get started in the markets and what attracted you to the stock market?
So I began my career in capital markets way back in early 90s. I would say late 1989 to 1990s. So I was actually doing my law and ACS. So within the ACS, which is company secretary course on company secretaryship, I got interested in this chapter on company law, which spoke about how do you raise capital, what's in public issue, etc. So that's what first got me interested in the public issue capital market side.
Right.
Then, of course, I also had the habit of reading a lot of books and magazines. So in those days, India was just opening up. So to read something in newspapers as to what could India achieve was something very exciting for me. And some of the books, even in those days, I had read that book, One Upon Wall Street.
Right.
Or I was trying to understand that book. So that got me excited. So even though I did my law and ACS, I never pursued that career. I came into the capital markets way back in 91.
Right. So it's been a pretty long journey. Actually, the Harshad Mehta scam was also happening right there. And see, I think like 70% of the podcast audience is under 35. So can you briefly explain what was that scam and what did you personally learn about the Harshad Mehta scam when it happened?
See, the scam was essentially using a third party. So if you are a broker, you always had a float with you. In the sense, some clients would pay you advance money. Sometimes you could keep your shares and borrow money, and you could rotate that in the market and then return it back to the client.
Right.
So in the Harshad Mehta scam, very briefly, if I have to tell, he used the banking system, banking money, which essentially banks were investing to buy, let's say, bonds and those kind of securities. But this broker somehow found a way to invest those large amounts into the stock market and then use that to invest for around 10 days, 15 days cycle. And then he would sell and return back that money. So because he had access to large amounts of money, any action from him would also result in stock prices going up. So that in turn attracted a lot of other people. He could also sell easily and give back the money. Now this is of course a dangerous game. You can continue doing this as long as the flow of money is very easy. So when that stopped, when questions were being asked as to from where he got the money, and that got briefly stopped for a variety of reasons, everything came out. And then people realized that it was not genuine money, but it was fraudulent source of money, which pushed up the stock prices. So the circus ended there. So since it had to end, then you had to take the pain. So stocks which were artificially boosted up had to decline the sharpest. But unfortunately, in that whole period, a lot of retail investors also got caught.
Yes.
Because they were looking at share prices, they were looking at the trends and felt that there is money to be made.
Correct.
Short term, long term, whichever way you looked at it. And they were caught very badly in that. So a lot of people, I think, who invested at very high prices, peaks, lost a ton of money, and there was a lot of anguish in and around that time. So personally at that time, it just, for me, the big learning was that it's never an easy game. When I joined, this entire Harshad Mehta boom began, it looked like an easy game. Yeah. But as you know, that things cannot sustain like this. So by nature, I was cautious, so I didn't personally lose much. But it was sad to see a lot of my clients and people who had speculated in the market lose a lot of money. So the learning was be cautious. While stock market is a great place to invest and make long-term money, don't speculate, don't speculate, don't leverage, don't use third-party money to invest. Be careful where you are investing. All those lessons came through.
Correct. And I think the way you talk, you can see that Quantum Mutual Fund is actually a unique AMC in many ways. And why don't you tell me about your journey with Quantum? How did it start? And what are the things that the company did to set itself apart from other asset management companies?
So I began my journey in Quantum in the year 1996. So prior to that, in the early Harshad Mehta boom, I was more on the trading and the operations side.
Right.
But I was keen to do research and I was working in Hyderabad in those days, and research was not available in Hyderabad. So I moved to Bombay. So for a year, I worked with some other company, and then somebody introduced me to Ajit Dayal, who is the main founder of Quantum. So I met him, things worked out, and then I joined in May 3rd, 1996.
That's my birthday. Yeah.
So it's been a great journey since then. Ajit was a great pal, great founder, a lot of inspiration, a lot of learning from him. So we did that, and very early in the game itself, we all understood that the importance of processes, importance of doing things in a certain way. So when we launched our mutual fund, we were very clear on many aspects. Let's say from a cost perspective, we said we are not here to just earn high fees. We should earn reasonable amount of fees. So therefore our fee structure was set at a reasonable level.
Right.
Second, we said we should always have a team. There cannot be a star fund manager or a star research analyst. So we should work towards building a team. So we did build a team. And also in portfolio construction, it is always good to have inputs from a variety of people. So we said, let's also have a portfolio construction process run by a team. We can discuss and debate, but we should never have a situation where only one person takes the final call.
Right.
So we implemented that. And then, of course, a lot of time we spent on ensuring that we do a lot of research on companies, build models, find out what are the key things in the industry, find out what are the key things in a particular company, what risks could arise, how can we be conservative, how do we ensure that we don't get carried away by what is the most popular thing around. So those are a lot of learnings which we implemented. Of course, this does not mean that you will not make mistakes. We also had our fair share of mistakes in the past. But as they say that at the end of the day, if you have more winners than losers, in the long run, it will tend to do well. Sporadically, there will be that bad apple where we may have misunderstood, misanalyzed, or give a more longer term time frame for that, which may or may not have worked out well. So the learning has been across all these parameters: processes, team building, importance of looking at fundamentals, and learning from our mistakes. Customer is the main person for whom we should work.
Serving actually, right?
Keep the cost low, and always have a direct channel of communicating. The best thing for us has always been that, we have gone across cities to meet people and to speak with them. And that is always good. The more you interact with clients, they also understand your process very well. And at the same time, there is a bonding between us and the client. We understand them well and they understand us equally well.
I think what's interesting, what you said is about team building. And I think that probably helps how you're so unbiased. So there's no one fund manager's bias into building that portfolio. And that's what perhaps you're trying to do there. Yes. And also perhaps what it also helps in, and I've seen this with the funds, is that there is no, you won't chase after the hot stock of the week or the quarter. And perhaps you stay away from that using this process. Any truth to that?
Yeah, so on the second part, like for instance, if I have to give an example of say 2005, 6, 7, that period. Yeah. In that period, again, India was a very hot destination for investments because India was part of that BRIC story. Brazil, Russia, India and China, and a lot of money was coming into India. And significant amount of that money was again going into what was perceived as growth stocks. Like for instance, the big box retailing was very popular in those days. Okay. Right. You had some banks which were growing very, very aggressively in those days. So they were very popular. So we stepped back and said that, this big box retailing will change dramatically because even with at that time, the Amazons of the world had not yet
come into the picture. Correct.
When we looked at international big box retailing model, the way it is constructed, the way the goods come in, the way customers come in, it was very different from the way it was constructed within India.
Yeah, which is much more fragmented.
Yeah, and second thing was on the balance sheet. Like, many of these companies, they started going into smaller towns, smaller cities. And we always had doubts whether all of those cities will flourish, whether this one big box retail will be able to get large amounts of clients. And second thing is very aggressive. When you grow very aggressive, you also tend to leverage and your balance sheet then becomes bad. But at that time, these kind of stocks were very popular.
Right.
So people would ask us questions why you are not owning them because, those stocks were zooming in terms of the price. And we had to defend and say that we would rather have a conservative. We also were there in that space.
Yeah.
But we had a more steady state company growing at a slower pace, good balance sheet, etc. So that is what I meant when I said that A was popular because it was growing aggressively. Share prices was increasing dramatically, while we were preferring within the same space a company B, which was slow in growth, but had more solid fundamentals.
Correct.
So one is to avoid a popular stock, and second is to have the conviction to remain invested in the slow moving stock.
Absolutely. I think I read a study somewhere where they were listing out, and you'll cringe at this, Subbu, a list of 10, 20 stocks which are the top gainers of the year, right? I know you'll cringe at this. And if you see the next year, almost all of those stocks would be the worst performers the year after or a 2-year period later. So I think when beginners start investing, they start seeing these returns of a single stock and try to chase it. And that's one of the biggest mistakes they make.
That's
great. So let's move on towards what's happening in the market right now. Subbu, for an investor who has no clue about what's happening in the markets right now, could you give us your view in brief? What's happening in the markets just to set some context?
So just to set the context is, the COVID event, the virus event, which took the world by surprise, I would say, because the rampant way in which it grew from China to the rest of the world came as a first shock. And then as economies started locking down, closing their cities and asking people to stay at home, it had various impact, people started worrying how businesses run, what kind of earnings growth could be there, and how long this lockdown will continue. And then, of course, you have enough literature out there on the internet, trying to estimate as to how many people could suffer, how many people may die. So all of this came as a surprise. And at the end of the day, in stock markets, you really are investing for earnings growth. And suddenly that earnings growth is not visible.
Right.
In fact, from growth, it's quite possible that in a year, it might even decline.
Correct.
Right? So you have to react. So people started reacting. And in India's case, that is what happened. And particularly in India, because we also had a large pool of foreign money invested in India. Many of them, they invested in India without probably understanding India very well or the long-term opportunities in India very well. So those kind of investors, plus investors who needed urgent money because they faced redemption in their cities or in their countries, sold off. So the reaction was the decline, very sharp decline. So if you look at from the near-term peak, I think they have declined by more than 30% or 32%. So it's a shock reaction to a new situation where it looks like the economic growth may stall, earnings may not come, and it's a reflection of that. And on the downside, it always starts to reflect fear also, right? If on the upside, you have growth plus greed pushing it up. On the downside, you have earnings growth declining. You know that. Plus there is a fear, so there is an additional sell-off. So it tends to swing very wildly on the other way as well. So that is what has happened, the decline of around 30% from the peak. It's a fear of what will happen from this event.
Right. So in that setting context, you use the word fear and 30% fall, sharp fall, sell off a lot, outflow a lot. And I have to ask this question, and I have to get it out of the way. Is the world ending, Subbu? Is it time to panic and sell everything? Is it all over?
No, I don't think so. See, we all trust our own capability, the capability as human beings. We have seen diseases and we have found solutions. So I don't think it is the end of the world. And if you really have to very, very carefully read about this particular disease. In fact, I would even urge you that on our website, my colleague Ajit did a podcast on this COVID. And if you really look at the statistics, you will find that it's not as fatal as people imagine it to be, right? So that's only one aspect. So I'm saying that we will come out of it. It's definitely not the end of the world. And therefore, you don't need to panic. You don't need to sell off. Even if you sell off, you have to put that money somewhere else, right? If it's the end of the world, then where will you put? So first is this view you need to have that it's not the end of the world.
Yeah.
You should believe in that. And then therefore, accordingly, depending on your risk appetite, you can always juggle the portfolio to ensure that you are invested in the right asset classes, which gives you comfort as well as growth.
Absolutely. I think the key message here is don't panic. There have been sell-offs in the past. This is not like this is happening for the first time. It's happened so many times. And I think the media makes things worse, Subbu, right? Because at the top of the cycle, we see everything is rosy and beautiful. And on the way down, it's the end of the world. But these extreme emotions is what catches us by surprise and is incorrect, right?
Yeah, that's true. It catches us. I will also say that it's not just the media. The media probably is only one aspect. It's the easy availability of news now. You have news available in so many formats, from whether it's from SMS or WhatsApp to news website. The overload of information sometimes can, result in very different kind of reactions.
Yes.
So you have to be careful what you read, and you need to identify sources which are credible and you feel comfortable with that particular view. Not get swayed by everything which you read.
Correct. So having perspective on this, like I said, you've been in the markets for almost 35 years now. You've seen crashes before. We've seen a crash sort of just now. Some things will remain the same in a downturn, right? So can you tell me what things have remained the same in the crash you're seeing now, or the fall you're seeing now, and the falls you've seen in the past?
See, what remains at all points in time is markets eventually start to reflect fundamentals and earnings. Right? Across board, you take any incident, whether it was, we spoke about the Harshad Mehta scam, whether it was Harshad Mehta scam, whether it was the tech bubble, whether it was SARS, whether it was swine flu. At the end of the day, markets will have to reflect the earnings. So as long as you are focused on what is the economy doing, what are businesses doing, what is likely to be the earnings growth, then you are, I would say, well situated to absorb the volatility. So the one thing which remains stable across everything is come back to the earnings. Markets will go up, markets will go down, eventually start to reflect the earnings growth. So earnings is the one key thing across every incident which I spoke about. Markets will come back to reflect earnings.
And the only thing for that to come into fruition or for it to manifest, I guess, is just time, right? I think that patience part is needed for all of us.
Yes.
Okay. So one question on the AMC management side, Subbu, you guys are managing money. And right now, how difficult it is, or rather, how are you deploying fresh cash in this noisy and volatile environment? Has anything changed?
So by and large, our fund managers, I think they have been investing in this market. Any fresh cash coming in, whatever little cash we had, it's been invested. What we try and see is in this market, what are the risks every company would be facing? So do we have companies which have strong balance sheets? Are they over leveraged? Because if you are over leveraged, then you will be weakened further.
Yeah.
We try and see that A, it meets our valuation, and B, that the balance sheet is strong enough and good enough that it can sustain any slowdown. So we went through every stock in the portfolio. Our fund managers went through every stock in the portfolio. And then we came up with this, that the balance sheet looks good. Yes, there will be a slowdown, maybe one quarter, maybe a few months, but these companies have the financial muscle to last this downturn. Right. So that is what an exercise we did. But otherwise, given the fact that the markets have come off from the peak, valuations definitely started to look attractive. So whether you look at the Nifty PE, it's probably closer to around 17 times now.
Yeah.
Very close to long-term averages.
Yes.
Right. You look at price to book, it's also around 1.8 times, very close to very long-term averages. So it definitely looks attractive to stay invested. So one line answer to your question, we have been investing.
Perfect. One question, suppose someone has done their basic financial planning, they have cash in the bank, they've done the insurance, health insurance, the emergency cash, all of that has been done, and yet they have some surplus cash. Now, assuming that they've done that, is this a good time for people to start investing if they're not exposed to equity?
Yeah, so if you have done all your financial planning and you know what's your net exposure to equities you need to have, I'm presuming when you say investment, it's in the equity space.
Right.
Then yes, then it's a good level to invest in. See, time, when you say time, we always say it's always a good time to invest in equities. Right. But it'll always depend on two things. A, the time horizon you have. B, the risk appetite you have. The longer the time horizon, the better for you. Right. So you can stay invested. The shorter the time horizon, you need to calibrate your investments in equity. So at this point in time, if you have a long-term horizon, you have the risk appetite, it's a good time to invest.
To invest. Perfect. So one thing about investor behavior, because you see a side most people don't, right? You can see the inflow and outflow of retail investors. So what are some silly investor behaviors that you've noticed over the last few decades that investors keep doing on the retail side?
Yeah, so it's not fair to say silly because it's lack of experience in how to look at things, right? So the people who have come into investing in equities without knowing what is the product about, what is equity about, then they make the mistake of only looking at near-term numbers, near-term past performance, and then they make the mistake of very aggressively allocating. Some of them make the mistake of identifying directly companies to invest rather than mutual fund.
Correct.
So it all comes in that excitement of, whatever people have been talking around. You hear what your neighbor said, your friend said, and sometimes people make the jump into conclusions and they make the mistake of investing.
Yeah.
At the same time, you have the other extreme also, where if the markets come down dramatically, then that's the time when probably you should add more money into your investments. There are times when people shy away. Either they stop their investments, or sometimes they may even remove their investments. These trends we find across time periods, particularly the new set of investors who have not seen cycles.
Yes.
They also tend to do this. So our way of educating them is always that first and foremost, have a long-term horizon if you are in the equity space. We understand that equities will always be volatile for a variety of reasons. Markets may go up or down. Eventually, it will start reflecting earnings growth.
Okay. Right.
So if you understand, then your way of investing will change. And never invest just based on the recent performance. Look at the very long-term performance. And if the long-term performance is good, then you have better reasons to invest rather than just look at the near-term performance.
Right. I think this was interesting when you said that some investor behavior, not silly, they try to invest in a particular company, and these are good names, big names. You've heard of them. You've probably even done business with them as a customer, and you start to invest and they fall, and then they start to invest again and it falls further. And of course, they get hit on the head. And I think that is something that's really bad. I think your solution to that was, if you're new, you should think in terms of portfolio versus one direct stock. Is that what you were saying?
Yeah, so one is now what you are saying is actually trying to average if you are investing in a particular stock. Averaging is a good idea, but at the end of the day, you should also know how much you want to invest in that particular stock.
Right.
So in our portfolio construction process, we have something called at cost. At cost, we will not go more than 2%. Or
right.
more than
others. There's no limit to it. You just keep averaging. Right?
Yeah, so you have to put a limit.
Okay.
You can't be in a situation just because it is going down, you keep on averaging.
Right.
Any averaging, of course, is based on one clear condition: is you should always relook at the fundamentals of that investment.
Did something change?
If the fundamentals has changed, if the fundamentals are deteriorating, then it doesn't make sense to blindly average.
Sure.
If the fundamentals are by and large okay, but near term there are some issues being faced, then it's okay to average, but you should always have a limit as to what should be the amount you will invest and average. You can't put more and more money behind it.
Correct. You were talking about research and you said fundamentals. So this is a good question. What is the quantum philosophy of picking stocks and building a portfolio?
So the philosophy is, we call something value philosophy.
Right.
In very simple term is, in every company, in every business, we try to analyze and come to a fair value of a company. That based on these returns, based on these margins, the company should be worth X. If the company is worth X, then we are okay to buy it at X minus 20% or X minus 30% or X minus 40%. These kind of metrics you can have. So in our case, we look at the company, we arrive at an intrinsic value, which could be a combination of earnings potential. It could be earnings potential. It could be, in one case, a combination of earnings plus assets which the company has.
Right.
So there are a variety of ways you could value a company. You could use the cash flow of a particular company to arrive at a fair value. And then we will buy it only if it is available at a significant discount to that fair value.
Right.
So let's say you found that a fair value of a company is 100. Most ideal situation would be if we are able to buy it at 40% lower than that.
Wow. So that's the margin of safety also. Okay.
But in many industries and many companies, you will not get that kind of discount.
Correct.
Some very high quality business like, say, consumer staples, you may not get it. In which case you may have to live with a lower discount. So our way of identifying stocks would be identify the fundamental value of a company, find out the intrinsic value, buy it at a good discount to that. As you rightly said, there is a margin of safety, and that is what we will do. But while investing, we will try to analyze what is it that drives the earnings. What positioning does the company have? Are they dominant in their product portfolio? Do they have great distribution system? Or do they have great assets which are yet to be sweated? Do they have a good management team which takes into account variety of risks? So all of these considerations will go into analyzing. So as we said, we look at the company strategy. We will look at their finances to see whether the strategy can be met through those finances. Does the management have the bandwidth to manage any unwarranted risks?
Right.
If all of this looks okay and we are able to come to a fair value, we will buy it at a discount to that fair value.
So this discount actually doesn't happen all the time is what I understand. You need to wait for some time for some really tasty investments to take fruit. So I'm sure this is an exciting time for you from an investing perspective over the next 1 year, I'm guessing, right?
Yeah. So when you look at, you are right. So when you look at such a sharply declining market, based on your long-term assumptions, you will find some good stocks being quoted at far below the intrinsic value. Right? It may be 20%, 30%, 40%, but you will find opportunities in these kind of markets. And that's why we said that our portfolio managers have been busy investing.
Right.
Found some new names.
Fine. So one question about index PE that I wanted to talk about. Now, if you look at the index PE, like you rightly said, we're around the 17, 18 mark. And it's fallen. It's almost at the average of the last 20 years. But the E component, that's the earnings, we don't know that yet. So what do you want to say about that? Like that earnings can change. So will this PE chart actually change? Let's suppose the earnings was supposed to be 100, but it's at 60 or 70 because of this lockdown. Will that PE ratio line actually fall?
Yeah, see, now the PE has fallen, the E also will definitely fall. So you need to have a good sense as to where the E will finally settle, the longer term E will finally settle. And that will be based on your analysis of the companies which you track, your analysis of the particular company which you are meeting. It's very difficult to say that all companies will have a same kind of earnings decline, right? It may not be so. There will be some which are better placed, like we were discussing at the start, that digital companies like yours are actually having a very good business time right now.
Right.
If there was a listed company in that space, probably their earnings growth will be good.
Right.
While a company which is largely, let's say, consumer driven, I want to say a hardcore consumer driven like a two-wheeler company, they will face some challenges because for the next couple of months, the earnings growth will be slow, sales will be slow, and the E will impact. So you cannot say that E will not go down. It will go down.
Yeah.
But because the P also has come down to attractive levels, even if the earnings growth is tepid, it looks interesting enough to at least warrant a serious look at the stock markets.
Right. Yeah, go ahead.
So I will also add one more point over here. So even if you look back, the index levels, it has probably gone back to where it was maybe in 2015 kind.
Yes.
And between then and now, there has been an earnings growth, right?
Yes.
There has already been an earnings growth. So to that extent, it definitely looks, at these levels, it looks cheaper. Since 2015, I think the cumulative earnings growth on a very broad basis should have been around 15%. So the index has gone to that level from where earnings growth has already happened. So to that extent, it does look a little attractive right now.
Perfect. One technicality that I wanted to ask now, the earnings season is about to come, but apparently I think it's been moved to June or I don't have clarity on that, but the announcements might be a little late for all the companies to give the earnings. Now, if that happens and overall, if you had to guess for Nifty 50, do you think overall the growth of these earnings will actually reduce significantly when the earnings are actually announced?
See, I don't really track on a quarterly basis to tell you that assessment, but you can look at it. No, this month we have had a lockdown for close to, let's say, 15 days, or it started on 24th, right, roughly around 24th. So even if you take 7 and then we had already some slowdown happening, maybe in the month of March we must have lost around 10-15 days, and March has ended. So while this quarter's number will reflect some slowdown. It may not be very dramatically different than what you estimated, because the actual lockdown happened only from March second week, right? The third week, to around 20th, 24th. We had that 1 day closure on one day, and then we had this lockdown coming on 24th. So prior to that, the business was running as usual, maybe a little slow, but it was still running. Right. So I'm saying this quarter, maybe it will not reflect. It all depends on how much more lockdown we will have. And then maybe the next quarter will be bad if the lockdown continues for longer.
Correct. Fine. So that's an unknown. Actually, nobody knows. Yeah. Something about building a portfolio, Subbu. If I wanted to start building a portfolio for the next 20 years and I'm new, how do I use equity? How do I use debt? And let's assume I'm under the age of 35. What should I do?
So if you're under the age of 35 and you have the appetite to take some risks, then you should have a higher allocation to equity. So a very classical model which many financial planners would say that if you have the risk appetite, you have a long-term horizon, you should have a higher amount in equities. At Quantum, what we also tell or frequently communicate is that on the debt side is where we tell people that you should, on an overall asset allocation basis, let's say you should definitely have around 10 to 15% in gold.
Right.
That's been our, depending on, at what prices, we have always recommended anything between 10 to 15%. Okay. Then on the debt side, we have largely said that you should have at least 1 year of expenses or 2 years of expenses in liquid funds.
Right.
Things are changing so dramatically, if people lose jobs, till the time you resettle, you have at least a cash flow going in. So therefore have something in liquid funds. So we don't really recommend investors to be in bond funds, because bonds can also be volatile depending on how interest rates move. So our advice is gold, then liquid fund, and then the balance you can have it in equities. And in the equity space, again, create a nice pyramid, in the sense the larger proportion of that pyramid should be in large cap, larger companies, and then smaller proportion in mid-sized companies, and very small proportion in small cap.
Correct.
The mistake we find some people do is when it comes to the equities, they are already taking the risk of being in equities.
Right.
Without knowing, they take the additional risk of being in small cap and mid cap. And when the going is good, it will give you great returns. Otherwise, it can be terrible.
Yes.
So I'm saying once you have done this, within the equity space, if you are a reasonable man with reasonable risk appetite, have a larger proportion in large cap, then smaller in mid cap, and then very small in small cap.
Excellent. That was beautiful advice. I think people can adjust according to what they feel is comfortable based on this framework. And Subbu, before we end this, a little bit about you. How do you invest? What do you do personally? Is it all in equity, or are you more in debt, or how do you personally invest?
So personally also, I invest a large portion of my saving only goes into mutual funds. Right. Number one. Number two, because I'm in the field of equities, my career is anyway exposed to equities. So I have to be consciously aware of that. So therefore, I always build asset classes which are a little more diverse. Right. So within Quantum, I have investments in Quantum Long-Term Equity Fund. I like a lot the Quantum Multi-Asset Fund. If you look at our Quantum Multi-Asset Fund, it sort of invests between equity, debt, and gold. And I find the returns to be very attractive there compared to keeping the money in just fixed deposit.
Right.
So Quantum Multi-Asset Fund is where I invest. And then because I also know that apart from the value fund, there could be other fund managers who are good at their work, and there might be some mid-cap funds which are attractive. Instead of me identifying a mid-cap fund, I prefer to invest in Quantum Fund of Funds.
Right.
So which is a fund of funds, not exactly like an equity fund in terms of a tax benefit, but nevertheless very attractive in terms of returns. A fund of funds will invest in other mutual funds, and it can have a combination of large cap, mid cap funds as well. So you get the benefit of both the mid-cap funds as well as the large-cap funds.
Nice.
So I invest in these three, and the rest is all in either gold or in liquid funds.
Do you have a fancy car, a fancy house that you bought? I've heard stories about this. I have to ask you. Everyone at Quantum doesn't believe in all of this. Is it true?
Yeah, I would say touch wood, it is true. It doesn't come by nature to own anything flashy, or as long as we have something which is moving from point A to point B, where we can take our families out or go to offices in time, that is perfect. We don't really need any fancy stuff.
Asset allocation everywhere, Subbu, even in these things, I think, right? So you don't have to, no allocation to flashy things, like zero.
Yeah, no, you say at the end of the day, I keep going back to what my colleague also Ajit says, do things which you enjoy doing it.
Yeah.
Like, don't like flashy stuff. There's no point in going into flashy stuff, right? I enjoy my house, my car, my work. So as long as that is there, then things should be fine.
Absolutely. The first time we met, you gifted me a book on investor behavior. I still have it here, but I have to ask you this. What are your must-read books that any trader or investor should probably read?
See, trader, I don't know. To be very frank, I have one or two books which was, I don't even remember the name. Somebody had recommended, some trader had recommended that to me. Right. But fundamentals, it goes back to the traditional books which I loved. As I said, I read One Upon Wall Street many years ago.
Yes.
You have the common stocks and uncommon profits was something which I loved. And then in general, to understand the markets and the maniacs around it, the Charles Kindleberger book on, there's one book, I don't exactly remember the name, but there's a book on mobs and mob behavior.
Okay, so mass psychology.
Yeah, so you could look at that, and then needless to say, The Intelligent Investor is always...
that is such a hard read, actually,
Yeah, so it is. So I would say I enjoyed reading that Phil Fisher book.
Yeah.
Which was a little more fun to read. Although it's a very old book, but it was still a lot of insights, good insights over there.
Excellent. I think this podcast was insightful. Thank you so much, Subbu.
Thank you. Thanks so much, Pratik.
This conversation is for informational purposes only and should not be considered as investment advice. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Please consult your financial advisors before making investments.